Ladies and gentlemen, welcome to the Capital Small Finance Bank Limited Q4 and FY26 earnings conference call. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then zero on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Sarabjit Samra from Small Finance Bank Limited. Thank you, and over to you, sir.
Thank you, Gitesh. Good afternoon, everyone. I am Sarabjit Samra, Managing Director and CEO of Capital Small Finance Bank. Welcome to Capital Small Finance Bank Limited's earnings call for the quarter ended financial year 26. We thank you for joining the call this evening. Joining me today are Mr. Munish Jain, Executive Director, Aseem Mahajan, Chief Financial Officer, Raghav Agarwal, Chief Credit Officer, Branch Banking, Sahil Vijay, Chief Treasury Officer and Investor Relations Lead, Bharti Babuta from our Investor Relations team, along with our IR advisors, SGA. I will begin by sharing our perspective on the operating and macroeconomic backdrop, after which we will discuss the bank's performance and outlook in greater detail. Financial year 26 was a year the Indian economy navigated with quite resilience. The global environment remains challenging, with the Middle East conflict impacting energy markets, elevating commodity pricing, and moderating global growth expectations. For emerging economies like India, these developments have resulted in some volatility in inflation, currency movements, and capital flows, largely linked to fluctuations in crude oil prices and global risk sentiment. Amidst this backdrop, India continues to stand out as one of the fastest growing major economies, with GDP growth expected in the range of 6.5 to 7%. Rural demand held up. Government capital spending continued. The Reserve Bank of India's decision to begin cutting rates after a prolonged pause signaled a shift in the macro environment that we believe will benefit borrowers and credit growth in the months ahead. In the banking system, credit growth has remained strong at about 16%, while deposit growth has relatively moderate at 13 to 14%, leading to increased competition for deposits and some pressure on funding costs across the sector. We completed our first decade as a small finance bank. The foundations we built give us strong conviction about the road ahead. Capital Small Finance Bank remains well positioned, supported by its deep presence in semi-urban and rural markets, a secured and granular loan book, and a diversified retail-focused deposit franchise. Coming to our Q4 financial year 26 performance, we witnessed steady momentum across key business parameters. Total deposits crossed 10,000 crore, growing 20% year-on-year, with CASA broadly stable at 35%. Gross advances at 8687 crore, registering 21% year-on-year growth, led by traction across MSME, mortgage, and agriculture segments. Disbursements remained healthy at 919 crore during the quarter. Asset quality remained stable, with GNPA at 2.5% and NNPA at 1.2%. Net interest margin stood at 4.1%, while profit after tax for the quarter at 40 crore. 10 years as India's first small finance bank, 26 years as a banking institution, the opportunities ahead are larger than the one behind us. With that, I would now like to hand it over to Mr. Munish Jain, who will take you through the detailed financial and operational performance. Thank you.
Thank you, Mr. Samra, and a warm welcome to everyone on the call. I will now walk you through the key business and financial highlights for the quarter and financial year ending March 2026. As of March 31, 2026, our gross advances stood at 8687 crores, reflecting sustained momentum in credit growth. On a year-on-year basis, advances grew by 20.9%, while sequentially growth stood at 6.4%, underscoring both consistent execution and healthy demand across our key lending segments. The growth in advance continued to be driven predominantly by our secured lending products, and around 90% of the loan book continue to be secured, with around 89% of our non-corporate portfolio is being collateralized by immovable property/bank FDRs. The average ticket size of our portfolio stood at 18.3 lakhs against 17.8 lakhs at the end of Q3 FY26, reflecting our granular, retail-focused and risk-conscious approach. Our continued emphasis on well-collateralized assets reinforces the quality, resilience, and the risk-mitigated credit portfolio. The growth driver for the quarter is MSME/business segment, which grew by 9% on quarter-on-quarter and 46% on year-on-year basis, followed by LAP, which grew by 5% on quarter-on-quarter and 19% on year-on-year basis. Fresh disbursement stood at 919 crores during the quarter and 3,508 crores during the year, registering a robust growth of 20% and 23% year-on-year basis respectively. This sustained momentum underscores the continued strength in the demand across our key lending segments and the effectiveness of our focused business approach. Geographically, growth outside our home state of Punjab continues to outpace the overall bank growth. Advances out of Punjab grew more than twice the Punjab growth rate on year-on-year basis, demonstrating the deepening strength and increasing traction across our newer operating geographies. Out of Punjab, advanced portfolio constituting 24% as on March 31, 2026, compared to 21% a year back. Asset quality improved and remained well managed during the quarter, with gross NPA stood at 2.54%, improving 14 basic points sequentially and 4 basic points year-on-year basis. Net NPA stood at 1.24% compared to 1.35% a quarter back and 1.30% in the corresponding period last year. The gross slippage ratio stood at 1.61% for the year and 1.27% for Q4 FY26, and net slippage ratio for the quarter being 0.08%, while write-offs remain almost nil during the quarter. Credit cost for the quarter stood at 0.26% and is consequent to enhanced PCR ratio to 51.89% as on March 31, 2026 against 50.45% a quarter and year back. Early stress indicator also shown improvement, with SMA-1 and SMA-2 accounts at 4.92% of the advances against 6.46% a quarter back, supported by proactive collections and early delinquency management. This highlights our prudent credit risk management recovery efforts, consistent portfolio performance, and reaffirming the quality and resilience of our portfolio. On the liability side, our total deposit crossed 10,000 crore mark and stood at 10,018 crore, registering a strong 20% year-on-year growth, underscoring the continued trust of our customers and the strength of our retail deposit franchise. Deposits continue to be the primary source of funding and constituting 94% plus of our outside liabilities. Bank continued to have stable CASA and the same stood at 34.5% as on 31st March 2026. Bank continued to focus on granular and retail-centric deposit franchise. Retail deposit share continued to be above 90%. Cost of deposit has started showing declining trend and stood at 5.75% in Q4 FY26 against 5.86% in Q3 FY26, that is a quarter back, backed by initial start of the deposit repricing. The credit to deposit ratio remained healthy, with average CD ratio of 82.3% and 86.7% being at the end of the year, compared to 80.4% and 82.2% respectively in Q3, reflecting efficient fund deployment. If I turn to the profitability, net interest income for the year grew by 13% on year-on-year basis for the year to 463 crores, and for the quarter, the same grew by 19% to 122 crores in Q4 FY26, and non-interest income grew for the year by 16% to 99 crores, and for the quarter, same stood at 26 crores. Pre-provision operating profit, PPOP, for the Q4 FY26, reflecting a strong 28% growth and stood at 62 crores, and same is 223 crores for the FY26, that is a growth rate of 19%. PAT for the quarter grew to 40 crores, that is up 17% year-on-year, and for the year, same stood at 141 crores. NIM showing early signs of improvement and improved to 4.06% in Q4 FY26 versus 4.01 in Q3 FY26, and the same is attributed to reducing cost of deposit on repricing and maturity. NIM for the year stood at 4.04%. Operating margin improved to 2.1% in Q4 FY26 versus 1.9% in Q4 FY25, calculated as a percentage to average assets, supported by NIM expansion and operating efficiencies. The cost to income ratio for Q4 improved to 58.2%. Return on assets for Q4 FY26 improved to 1.33% against 1.16% of Q3 FY26 and 1.36% in Q4 FY25. The ROA for the financial year 26 stood at 1.23%. Our balance sheet remained well capitalized. The capital adequacy ratio stood at 22.3%, and average LCR for the quarter was a strong 211%, providing sufficient headroom to support our future growth. As of March 2026, our branch network expanded to 211 branches across 5 states and 2 union territories, strengthening our presence in rural and semi-urban market, with 77.3% branches being Suru branches, which remain key driver of our long-term growth. As we look ahead, we plan to organically grow our secured loan book at the rate of 22% plus for FY27 and further accelerating the growth to achieve an advanced book of over 16,000 crore by FY29. We aim to expand our footprints by deepening presence in contiguous states and intensifying penetration within the existing markets with a target of 235 branches by the end of the current year and making it 300 plus by FY29. We expecting NIM expansion supported by continued moderation in deposit cost from repricing and improving CD ratio. During the current quarter, the benefit of deposit repricing has started showing initial sign, and cost of deposit for the quarter has declined to 5.75 against 5.86 a quarter back. This reduction reflects the initial impact of the term deposit repricing. We expect the benefit of repricing to accrue more meaningfully over the next 3 to 6 months. Statistically, 53% of present term deposit is high priced and due for repricing in the next 2 quarters. To achieve ROTA expansion in the coming year and with a target to make it 1.35% to 1.4% in FY27 and 1.6% plus by FY29 with a ROE expansion of 15% plus by FY29. We remain deeply committed to create long-term value for our stakeholders through responsible banking, customer-centric innovations, and sustainable financial inclusion. With this, now I request the operator to open the floor for Q&A session. Thank you.
Thank you very much. We'll now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone phone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Sonal Minhas from Present Capital. Please go ahead. Sonal ma'am, you can please go ahead.
Hi, this is Sonal. I hope I'm audible.
Yeah, Sonal, you are fully audible.
Hi, Manish sir. Hi, Sambhu sir. Thanks for giving me time. I just wanted to understand I look at your gross NPA table, and I'm just reading some numbers from there. The additions for gross NPA for this particular year was 25.3, and the additional provisions we made in the P&L are around 22 CR. So, if I am just tying the two numbers together, are we providing more? Are we providing, how are we providing? Basically, that's the first question.
Sonal, I just believe you are referring 25.3 being the Q4 number, and the
Yes,
year
Q4
number
numbers.
being 112.8.
No, so I'm just talking, Muniji, Q4 to Q4, both. Q4 mein the provisions are 22.
Provision in the Q4, or if I talk about the provision number for the Q4, are typically that include all the provisions, including the taxation provisions. So when we are talking about 22 crore provision for the current year, this also includes the taxation provision. So the provisions for other than taxation are lesser. Just we enhanced the provision coverage this particular quarter, and over PCR, which was typically 50.45% a quarter back, we have improved it to 51.89% presently. So we have increased the provision coverage and working about the net NPA by keeping in sight the profit earning. So
we've increased a little, not much, basically.
PAT, including PAT.
Okay, so we are summarizing, we have increased it a little, but not as much as what is looking in the numbers, because there are some provisions for taxation as well. Basically, yes. Got it. Sir, one more thing, between last quarter and now, if I look at the agriculture loans, the net NPAs are kind of sticky, while the book has grown a little. So, it was 2.75 in Q3 FY26. It's 2.76 now. So what is happening on the ground for this particular category? Any subjective input would be great to know.
As far as agriculture is concerned, during the period under review, that is the NPA were almost static, that is 2.75 and 2.76% respectively. So the accretion in the, and there was some accretion in the NPA during the current period, and there was also recovery during the quarter, but both are parallelly and in line with the historical trends. So nothing unusual, everything is controlled, and as always, it's completely in line with the overall NPA trend. So we are seeing a traction. If you look into our book, you will find the net NPA has improved in all the segments. In agriculture, it is static, but in all other segment, it has improved. So just it is a agriculture period. This is not a recovery period, because the agriculture recovery period are typically Q1 and Q3 when the cash flow comes. Q4 is not a cash flow period. So the majority of the recovery in agriculture will be coming in Q1 and Q3, because those are the cash flow period. This being a non-cash flow period.
So, Munishi, just to follow up on this, that can we assume that this number will fall down significantly after Q1, Q2, Q3 back to around 2%? If you're seeing a healthy recovery, if you're seeing this segment, no stress in this particular segment, should this significantly taper down? Because this has been sticky for this particular year. So just want to understand that.
Sonal, as far as the agri NPAs are concerned, I am not saying that it is coming down to 2% over the very next 3 to 6 months. Yes, we believe that it will remain range bound, and with remain range bound with the lower biasness. But just coming to 2 is very aggressive target which we can take internally. But on a public platform, on this particular platform, I believe we want to keep it range bound around the similar towards the lower bias levels over the next period to come. So if you observed in the period, we have grown agri has not grown that significantly. During the quarter, it has grown by 7%. But on the year-on-year basis, the growth is quite moderate. So with the growth coming back, now the growth has started coming back in this segment. So with the growth, this number will start getting automatically adjusted also, and we can see a better number as we move. But despite that particular factor, the NPA in this particular sector as well remain almost similar what was a quarter back.
Got it, Muniji. Thanks for explaining. I'll fall back in the queue. Thank you.
Thank you, Sonal.
Thank you. The next question is from the line of Aditya Mundra from My Temple Capital. Please go ahead.
Hello, sir. Am I audible?
Yeah, you are fully audible, Mundraji.
Yes, yes. Sir, congratulations on the good results. Sir, any guidance on any effect of ECL transition to ECL that we have on our credit cost? What would be that amount?
Circular on ECL has already been come. So we are still evaluating on the present new guidance which has come a couple of days back. So initial understanding, yes, we are still working. Initial understanding, it will not be PLN negative. So we will be either PLN neutral or PLN positive with this ECL. But still we are evaluating the new guidelines in detail. Initial review is it will not be a PLN negative for the Capital Small Finance Bank.
Okay, so what I understand is that you are sufficiently provided even if the new ECL's guideline come in, as per that also we are sufficiently provided.
Yes, that's what I try.
Including, okay.
That's what I mean.
Including in stage 2, I think where the minimum requirement is about 5% provision.
That's what I'm saying, Anandji. As far as the initial understanding, the whole of the ECL requirement, it will not be P&L negative. If I compare the ECL requirement provision versus the present provision held, it is not a P&L negative position, but still we are detailing the detailed discussions. So we expecting it to be PLN neutral to PNL positive biased.
Positive. Okay. And sir, this quarter, from even if I remove the effect of the labor code, which was there in last quarter, about 6 crores, even then our OPEX cost, so even then our OPEX cost seems to have declined quite significantly quarter on quarter. So is there any particular reason for that, or it's just business as usual?
If we look into our OPEX cost, the OPEX cost, if I exclude the labor code, it is almost 89 crore versus 86 crores. So
yes,
the impact of stress is only just 3 crore, so which is not a significant there. So this is basically because of it, there can be a lot of factors. There's some expenses which are not in temporary expenses for a particular period. So those are maybe incurred in that particular quarter. So otherwise there is not a significant decline. It is almost the same number as we have in the Q3. So because the expenses, provisioning and everything depends upon whether a lot of factors which are being considered for that particular point.
So there's nothing which is one-off or there's nothing which is unusual. It's in the normal part of the course.
Yes, Anand, it is a business as usual.
Okay. So sir, what should be our like OPEX to average assets? So what should be our steady state percentage that we should account for? Let's say for FY27, if you can guide, or on the cost to income basis, if you can guide, what would be our target?
As a percentage of the average asset OPEX, over business is over the medium term to take it below 2.85. Just in the year 1, that is our current fiscal FY27, we intend to keep it between 2.9 to 2.95 or 2.9 to 3. That is the broader range I can give. With the lower biasness.
Yes, sir. And that would be on the growth of like a guided growth of about 20% plus on the AUM.
Yes, we are targeting current year, we are getting guidance of 22% plus for the FY27, with the 2029 being 16,000 crore on the advance book.
And sir, one final question from my side, and then fall back in the queue. This agri growth has come very well on the quarterly basis. And there was some, like the last couple of years, there was some slowdown on the agri part. So what are the reasons that we are seeing on ground, and how much of this growth can continue and translate to annual growth also?
As we discussed earlier also, agriculture, one product which we were conscious earlier year because of certain ground level events which were solved in the last year begin. So we were expecting a growth, and the growth for the current quarter has started coming. So agri is one portfolio which we intend to continue to grow, but the growth in agri will be lesser than the overall growth. And never the over growth leader will be continue to be MSME, that is a business segment, and the LAP. They will be our growth leader in the coming FY27 also. But agri will be growing, but lesser than the growth, overall growth. But we are continue to put our focus on agri as we move forward.
And then if you could just say, which was that? Sorry, yeah.
Because we are not intending to do agri in the newer states like Rajasthan, Delhi, Himachal and UP. So agri will continue to be coming from Punjab and Haryana only. So that's the factor we all say ki agri we don't intend to grow as fast as the overall book. So agri will be growing and a decent pace from these two states.
And then if I can just squeeze in one more, you had decided on a co-lending that you will be considering growing on the other states, non-Punjab states through co-lending model. So how much has that started coming in this from this quarter, and how much of the book has come in? And what is our arrangement with the co-lenders in terms of the FLDG cover or any other business model that you could give some clarity on?
Anandji, let me clarify. We are not in a co-lending, but we are in a business correspondent lending model in which the business correspondent is originating for us. We are not doing the co-lending activity. In this particular thing, the credit cost, the credit risk is going to be with the originator. So his revenue will be tagged with the asset quality, and along with the revenue tagging to the asset quality, we will be taking an FLDG for the default risk. That if there is any credit default comes, then FLDG, we will be keeping a cash collateral FLDG with us for that particular loan portfolio which we'll be building. This quarter, the activity has been started. Last quarter, we signed off. This quarter, the prototyping production movement has come, and initially, the initial business start coming in. I will not say very, very large value because in the first quarter after activation, you can't expect a large value. But I'm happy to share now we are not having one, but more than one partner. We are having a couple of partners in this particular space. The traction is coming back, and we can see some good momentum in the period to come. Again, I reiterating, we intend to have more than 90 to 95% of the disbursement through our branch network only. So this is a reiteration. Even in the last call, we're doing it. So yes, this is an add-on to our growth, but our bigger growth driver will continue to be our branch banking.
Okay. And sir, how much is the FLDG cover that they are providing?
So FLDG cover is governed by the regulatory guidance, and that is 5%.
5%. Okay. Thank you, sir. Thank you. I'll follow that again.
Thank you, Anandji.
Thank you. The next question is from the line of Pritesh Bum from DAM Capital Advisors. Please go ahead.
Hi, sir. Good evening. Sir, just few questions. One is on fee income. The fee income has been relatively weaker. Generally, we see 4Q fee income a little better for the industry and for us as well. So why has it been weaker this time around, apart from the treasury income? But then, and how do you look at it going ahead?
Fee income, if we look into for the current quarter, on a value term, it is 25.8 crore versus 26.1 crore a quarter back. And if we look into the sub-components, the income from the advance has grown by 3 crores from 6.7 crores to 9.7, remains static on the operation-related fee income, and there is a slightly reduction on the banker commission. So, but there is some reduction we are seeing in the treasury income because of the opportunity available. So, our fee income, if we look into the asset percentage to the asset, continue to be 0.9% in both the quarters. So, it was 1% in Q4 last year. So, because of the certain factors, so yes, we continue to believe this number to be remain towards 0.85 to 0.95 in the coming period. So, with the upward biasness, so we are quite optimistic. But a very important point I like to mention, Pritesh, you look into all the fee income components, they are static state and with a multi-dimensional channel. So we are optimistic, we are confident to maintain and improve it. So overall current year, full year basis also, this is 0.9% and the same was 0.9 in the last year. And now earlier we were showing a momentum growth and we expect that some momentum will be coming in the current period.
Sure. Second question was on margin front. We've seen a little bit of improvement this quarter. Earlier, before the rate cut cycle fully kicked in, we had a view that we will improve our margins as the LDR improves. So we are today at about 83% LDR on an average basis, I think. So how is our margin progression going to be given that the rate cut cycle at least has paused now?
There are the two variables in this. One, our cost of deposit has started the first sign of improvement in Q4, which has improved from 5.86% in Q3 to 5.75% in Q4. Now, statistically, if we look, our present term deposit book, consisting of around 53% of the term deposit which are priced more than the present offer rate, which are due to be repricing in Q1 and Q2 of the current year. That is the June quarter and the September quarter. So we are seeing some benefit which will be pouring up from that repricing on their maturity, So that is the one benefit we can see to be building up the NIM. So we are expecting the NIM benefit coming from that one repricing. And second, we are 82.3% average CD ratio. So we intend to improve the CD ratio in the next year. Last year we increased it very slightly. So in the coming year we intended to improve it more sharply. And last year we continue to improve our deposit franchise also along with the decline interest rate trend was there. So we believe there will be some improvement. We are expecting some improvement in the CD ratio in the coming year, current year. So that is the second lever which will be over NIM expansion available. So in NIM we can see two expansion lever. One being the repricing of the deposit with 53% of the term deposit getting repriced in Q1 and Q2. Second with the LDA expansion. So with this particular thing with 4.06 being the NIM for the Q4. So we can expect better NIM in Q2 and Q1. I will not mention Q1. Just we will see slight improvement in Q1 and more meaningful improvement in Q2 as we move. Though this is a driver for the NIM. The second big driver which is available is typically that is that ROTA expansion will be with the NIM and also the OPEX. OPEX for the current year continue to be 61.2% on a year basis. So which we believe in the cost income basis we will see some good traction, and we believe that cost with the asset ratio it will remain in the range of 2.9 to 3. So which will be another traction for the current fiscal, and before it start pulling further down will FY29. So these two levers could put together. So we are anticipating a ROTA expansion for FY27, and we are targeting the full year ROTA of 1.35% to 1.4% for FY27 and 1.6% plus for FY29.
Sure, sir. And sir, last question will be on the yield on advances. From some quarter we had seen a very steady yield at about 11.1. And now it has suddenly dropped to about 10.8. One can understand there was a rate cut in December, but the rate cuts were earlier as well. So anything happened, or have you passed on any rates in terms of additionally, or is it like a business mix change which has led to this decline in yield?
There is nothing to worry about in this case. If you look into read it with the slide number 8 of the presentation, where we can see the interest rate versus Q4 versus Q3. There was a 25 basic points rate cut coming in this particular quarter, which has slightly impacted the yield on advances. That is the point number 1. But which may be affected the yield on advances by 10 to 12 basic points. So another 8 to 10 basic point impact is due to because this is the period in which the agri accounts become NPAs. So there is some agri accounts when become NPA, their interest get reversed. So which take care of the old interest earning to be reversed. So which impacted the interest yield temporarily for that particular quarter by 7 to 8 basic points. So that is another impact is there. So with these two impacts are there, but out of this around 10 basic point is in permanent in nature, but 10 is not. So we can see there was a 25 basic points rate cut for the current quarter, which are being due in the month of January. So with this particular aspect, if you look into any of the product, the agriculture over rate to last quarter rate is 12.62, now it is 12.54. Over housing loan last quarter rate was 9.83, now it is 9.85. Over LAP last quarter rate was 12.56, now it is 12.33. Over business segment last quarter the rate was 10.6, now it is 10.55. Over corporate loan last quarter the rate was 10.8, now it is 10.77. So the rates are in a right phase, so which is going to be available with us as we move forward as well.
Got it, sir. And last data giving question was on, can you give the absolute savings number in this quarter? Savings, absolute amount.
Saving amount, I missed what you said.
I mean, within the CASA, I wanted the savings share.
Percentage. Saving share. Okay, saving deposit share. So give me a second. The saving value is 3182 crores, which is constituting 31.76%.
Sure, sir. Thank you so much. This is helpful, sir. Thanks.
Thank you.
Thank you. The next question is from the line of Shripal Doshi from Equirus. Please go ahead.
Hi, sir. Thank you for giving me the opportunity. So my question was pertaining to our agriculture portfolio. So given the kind of geopolitical situation that we are seeing and the impact of the same, and also this year we are expecting that the rain there could be delayed rains and also weaker monsoon. So given this and also the input cost because of the geopolitical tension has gone up, so how do you see our agri portfolio to behave? While I understand that our agricultural customers are relatively superior versus the other guys, whereas our ticket sizes are relatively higher. But even from the behavior point of view and then how we are looking to manage that portfolio overall.
Shripal, if we look into the present agriculture portfolio, for just reaffirming, re-clarifying, we are in a 5 lakhs to 25 lakh ticket segment. That is, we are not below 5 lakh. That is small and marginal farmer lending. So, which is politically sensitive segment. So, that political sensitivity segment is not there with us, which has any potential of the problems with the potential political announcements. Point number one. Point number two. We are typically lender to that particular agriculture set who are cultivating ideally 2 MSP crops, but minimum 1 MSP crop. So, our majority of the agriculture guys are having the 2 MSP crop with 1 cash crop in between. So, with that structure of the agriculture cropping, so even if I'm talking about the early signs of the wheat, so wheat procurement seems to be decent and the wheat is coming well in control. And point number 2. If I talk about, so there are the 2 crops. Now wheat procurement is already on. If I get an early sign, it's a too early sign, but early signs are decent. That we are seeing a good wheat procurement and good cash is started pouring into the accounts. So that is the one clear indicator that the H1, which is wheat period, seems to be decent. So there is no challenge. Now, as far as the second point is concerned, when we talk about the monsoon related cropping, so Punjab, the good thing which happened over the Punjab over last some time is reaching up of the canal water even up to the last mile. So there is a good thing which has happened, and last year we have a very good monsoon. There is a good water reserves available. So with these 2 factors and also good ground level irrigation facilities available. So I believe it will be too early and too premature for me to comment how the monsoon will look like. But keeping in view these 3 scenarios, that is the last year water storage, which we seen there was some good high rainfall in Punjab and the water storage area at the optimal levels. So which is the one big factor. Second is the reaching of the canal water to the last mile. So that has been a big change which has happened over the last 1 to 2 years. And third, ground level irrigation facilities. So with these things, so we are not that worried. So at this point of time, yes, we see what will happen and we have a lot of levers available. That is a multi-level accounts available with that customer, collateralized by more than 200%. If the wheat is there and it being a paddy, there is a lot of alternate cropping patterns available for the farmers. So all these things are additionally available. So which is not making me worried at this point of time, keeping in view our present customer profile and the present situation. And I am again reiterating, we are doing agriculture in Punjab and Haryana only. We are not doing agriculture in Rajasthan, UP, Jammu, Himachal. So our susceptibility, our the challenges get reduced to that extent.
Got it, sir. Got it. That is helpful. So, we are confident that it should not impact our customer profile broadly. The second question was on the other income side. So while we have been talking about the initiatives that we've taken, and also you highlighted where we want to be in terms of as a percentage of total asset. But I mean, if you could give us, from the deconstruction of that the target that we have on the other income side, like what would contribute how much? If you could provide that sort of clarity, that would be really helpful.
So typically, as far as the other income is concerned, other income which is presently 0.9% on the asset basis, so we intend to make it between 0.85 to 0.95 also current year. So current year, the goal sheet which we have taken for the Ruta derivation, the number we have derived is 0.85 to 0.95 range. So with the upward biasness, so this will be continue to be supported by the four pillars. So yes, I believe there will be some better traction we can see from the advanced rated fee income, which has improved during the Q4, or just we can see from the versus Q4. There seems to be not an improvement because last time Q3 income was lesser and there was some allocation, first the distribution was there. But all other income, if you look into the operation rated fee income, if we compare with the Q4, it was 4.8 crore, now it is 5.8. Last year Banca was 9.3, it is 9.5. Yes, there is some moderation in the treasury earning because of the market conditions. So all the line items, all the streams are in the right phase. So going forward, we expect that over the distribution will continue to be typically around 33% towards banca and 66% towards non-banca, which will be there around 35 to 40 towards advance and remaining towards the operations related. So which we are well factored in, which we are well ready, and we are completely aligned to improve the net interest income. I will not say very significant improvement. Yes, there will be a improvement, marginal improvement. We want to take it from to this level to 0.95% level in the current fiscal, and then taking it to the next level in the period to come.
Got it, sir. That was helpful. Thank you, sir, and good luck for the next quarter.
Thank you, Shripalji.
Thank you. The next question comes from the line of Sagar Shah from Spark PWM. Please go ahead.
Yeah. Good evening, sir. And first of all, congratulations for a very good set of numbers, actually. My first question, sir, was related to net interest income. In spite of clocking very good sequential loan assets growth of around 4%. But still, actually, in our net interest income has been hardly been 2% on the upside. So first of all, I wanted to know that were there any interest reversals actually that led to such weak NII growth actually? And I'll follow up with the second question after this, sir.
So yes, in the current period, it is being a period in which the agriculture accounts were due for the NPA. So there was some accounts of the agriculture which is marked for the NPA, which brings along with it interest reversals. So there are slight interest reversals of 1 or 2 crores, which is the factor which is bringing it towards downward. But if we look into the net interest income, for the net interest income perspective, during the current quarter, it is 122 crore rupees, which was last year corresponding quarter, it is 103 crore rupees. And if I look into the December quarter, just open a December quarter now. 119. It is 119 crore rupees. So there is an improvement of around 3 crore rupees in this. There was some interest reversals. So, but overall, the growth of the net interest income for the current quarter is 19% and the top line growth of 20%. So if I talk about the NII growth for the Q4, it is 19% and the top line growth of around 20%. So with this, which both are very nearer to each other now. So there is not a wide spread between these two numbers if we talk as on date.
Yes, the YY numbers seem to be very good actually. So clocking very decent growth. But the QOQ numbers, as you said, due to the agri portfolio, there were interest reversals, and we see even in the net NP uptake of around 2.76% that led to the interest reversals. Is my reading correct, sir?
It's there is that factor will be always there.
Okay, fine. And my second and the last question, sir, was related to our exposure to NBFC MFIs. In this quarter as well, we saw our the net NPA inching up to 17.3% actually. So, and our total portfolio is also very small at around 39 crores. But any color on the same that are we seeing some green shoots there too, as we are seeing the MFI cycle to reverse? Is seeing some of the company disbursements numbers. So any improvements in that portfolio are we seeing, especially in asset quality, especially and also loan growth?
If we talk about the MFI, NBFC, MI segment, we are not very bullish on the NBFC, MFI segment. We are watching the market, MFI market, and when we get the comfort, then accordingly we will evaluate to jump again in the NBFC, MFI segment. But for the current quarter, we have not lended any fresh money to the NBFC, MFI segment. We just recovered what we have already lended. And if I talk about the value basis, this particular value, the outstanding net NPA now is 5.49 crores. And the same value a quarter back was 6.08 crores. So we typically in the current quarter, we recovered around 60 to 70 lakh rupees from those NPA accounts. So if I talk about the position as on date, keeping in view the present discussions with those lenders, so we are well confident that whatever is required to be provided has already been provided, and the remaining net NPAs is amount of recovery. We have already signed off the OTS with one of the lender, and the money for the current quarter has recovering purely as per the OTS. So I strongly believe the pain which was there in this NBFC MFI segment which has come in Q1 is fully provided for in the current year, and we are not carrying any baggage in the next year. So whatever is pending left, which we optically just 17.3 looks very high, but if we derive the value out of it, it is 5.49 crores, which is lesser than net NPs. So which is lesser than the value which is there.
Okay. Okay, fine, sir, fine. Thank you so much and all the best.
Thank you. The next question is from the line of Ryle S. from Sapphire Capital. Please go ahead.
Hello, sir. Good evening. Can you hear me?
Please come again.
Can you hear me? Am I audible?
Yeah, now you're fully audible, please.
Yes, sir. Just if you can, I'm sorry if you've mentioned this earlier, but if you could just help me with the credit cost guidance for this year. And our cost to income has, improved well in this quarter 4. So will it be range bound in the coming quarters? And if so, what will be the levers for that?
So if I talk about the credit cost for the current fiscal, that is FY26 was 0.26, and credit cost for the current quarter was also 0.26. And for the factors for the same, in the current year, we've seen some out of turn NPA slippage in NBFC MFI, and we provided materially amount for that particular portfolio, which we expect the loss. So that's the reason current year the credit cost being 0.26. And in the current quarter, we opted to increase the PCR which was 50.45. We improved it to 51.89 at the end of this quarter, which was 50.45 at the end of the last quarter. So that is the factor. So the current quarter cost, credit cost is a provisioning driven, not a loss driven. So that is what we have done. And if I talk about the credit cost going forward, we always intend to maintain in the range of 0.15 to 0.25, and we are quite confident to maintain in this particular range, just with a negative bias for the next year. So, but our range bound will be 0.15 to 0.25 for FY27. If I talk about the situation sitting in today, yes, we are looking at a lot of geopolitical environmental changes which is happening. As on date, if I look, I am confident to maintain in the range of 0.15 to 0.25% for FY27. And our stated objective is also very clear. We want to keep our credit cost on the downward to 0.3 up to FY29. So that is what we strongly believe, and we are confident to take it that way.
And sir, on the cost to income, yes, please.
It's about the cost to income. Cost to income, if I restore this ratio, if we compare both from the cost income perspective, this number was typically 58.9 or I say 59%, and for the year it is 61%. So we expect this cost to income ratio, if we calculate from the CI ratio or I compare it with the asset basis. So we believe in the coming period, coming FY27, with this number shall remain in the range of 2.9 to 3% if we calculate as a percentage to the average assets. So that is the guidance which will be we intending to improve cost income ratio from the full year basis. What is the number for FY26 versus what we were expecting for FY27? Given we have done all the costing or the middle management costing or the senior management head office costing has already been done. Now for any new branch expansion, no that cost is required for the current fiscal, that is FY27. Only the periphery, that is the last mile cost at the branch is being required. So which is giving us a confidence that we can look forward for some cost optimization, slight cost optimization in FY27 and very larger cost optimization as we move forward with the scale increase. Pretext basis, if we look into our vision statement, we are targeting 1.5x in the branch and 2x in the deposit advance growth. So that indicator itself clearly that we looking forward for the cost optimization. So we can see a better cost optimization coming in the medium term basis. But if I talk about FY27, you will see this in the range of 2.9 to 3% for the current fiscal calculated as a percentage to the average assets.
Okay, got it, sir. Thank you so much. All the best.
Yeah, thank you. Thank you, Sagar.
Thank you. The next question comes from the line of Ashwini Agarwal from Dempter Advisor LLP. Please go ahead.
Good evening, sir. Good set of numbers. So a couple of questions. One is, one of the participants had asked a question about the weather patterns and so on and so forth. Could you take us through sort of your experience in previous drought cycles in 2015, 16, or maybe 11, 12? How did your portfolio, behave during this period? Is there any historical anecdote you could share with us?
Ashwini, rather than just for a drought cycle, if we have a very recent development, that is the last FY26, we've seen a high flooding-like condition in whole of Punjab. So we've seen that condition in a lot of portion of the Punjab. So that is just very recent, around 9 months back or 8 months back. So we'll look into that particular aspect and look into the SMA number of Capital Bank and look into the net NPA and the gross NPA and the write-off numbers. So which is giving us a very, very clear signal that what we are doing. Point number 2. When we're talking about the drought-like situation, even if we go back to the history and look back into the all historical data points, we are landed in the agriculture since year 2000. So we have a track of 26 years. If we go back to the last drought, which is 2014-15 or 15-16, or rather I will say 14-15. There, if we go back to, I'm not having a handy number, so I can't comment upon that number at this with that authority. But to the recall, since I was handling that time also for some portion of this particular portfolio, so I am to my recall that there was no sudden supper in that year also. But the biggest testimony is even if I talk about the high flooding period also. So last year and over operating model. Our operating model is typically diversified income and assessing the income basis the agriculture as a business. In which and we lending to the farmer who is a progressive and cultivating ideally 3 crops in a year. So resulting in if there is some damage on one of the crop for some maybe 20%, 30% damage. So there is no loss which is parting on to the banker. Point 2, we are with the LTV downward of 50% in whole of the agri portfolio. 3, we are in a full-fledged banking with that gentleman that is whole of products. His and his family banking are with us. So with the relationship banking approach, point number 4. So all these pillars, all these hooks are a enabler hook and we are a agri lender for now 26 years. Seen all the cycles. Maybe a environmental, maybe a political, maybe a geopolitical or maybe even enmity actions. So all those actions, all those scenarios we have seen. So and we have not written off anything from the agriculture portfolio over last 26 years. The number of NPA which you are seeing is a cumulative, and that value is what we are not able to recover, even if we and not write off. It is fully with recovery effort only. So with this thing, we are giving us a confidence that with the operating model, which is a time tested, we are confident. So whatever we are hearing about the MET, but one important point, we are a Punjab and Haryana lender. And look, if you look into Punjab and Haryana, one good thing which has happened is reaching off of the canal water even up to the last mile. Reaching off the canal water up to the last mile is one of the big milestones. And we are, if we took statistically, Punjab and Haryana, where the ground level consumption is very meticulous and the other ground level store table is not showing a depletion over last 1 or 2 years. So with that static, and there is a huge irrigation-based opportunity infrastructure available for the ground level at the last measure also. So ground level irrigation is also available in Punjab and Haryana in all the farms.
Right.
With that, so that particular challenge is not fully looking that problematic for us in the coming period. But yes, we are keeping our eyes there open. And that's the reason we are always very conscious in the growth in all the segments. Wherever we see any bad time, there may be some scenario, maybe certain challenges may be coming. We are always in a conscious growth. We are a consciously aggressive banker.
Okay. And the second question is that in the new states like UP, HP, Jammu, Rajasthan, you said you won't do agriculture. So what kind of loan composition do you expect in these markets?
So like if I talk about Rajasthan is a huge MSME and mortgage market. So we will be doing MSME and mortgage. Jammu is a huge MSME market. UP is a good MSME and mortgage market. So there is a huge opportunity available in these two product lines. So we having a multi-product organization rather than a monoline product. We are a multi-line product organization. So the opportunity available in those states are phenomenally high in the products which we are mentioning. Punjab, Haryana has a very good agri. Just UP may we consider as some part of the UP for agri depending upon our combing. Our process of the growth is combing and carpeting. We comp, that is we understand that geography well by being present there in 1 or 2 branches. Comb it, then we carpet it. So that is the way after our learning with the combing activity, then we will expand it further.
Thank you, sir. All the best.
Thank you, Ashwini ji.
Thank you. The next question is from the line of Harshit Khadka from Robo Capital. Please go ahead.
Hello, am I audible?
Yeah, Harshit, you are fully audible.
Yes, sir. Thank you for the opportunity. I just wanted to understand like what kind of ROE and ROE profile are we looking for in FY27 and also going forward when our book reaches 16,000 crores in FY29.
We targeting ROA of 1.35 to 1.4 in FY27 and we are targeting ROA of 1.6% plus in FY29. If I talk about the ROE, we are targeting 15% plus ROE by FY29. So we are looking for the margin expansion both in FY27 and significant expansion by FY29.
Understood, sir. Thank you.
Yeah, thank you, Ashit.
Thank you. The next question is from the line of Rishi Modi from RDM Advisory LLP. Please go ahead.
Yeah. Hi, sir. Am I audible?
Yeah, you are fully audible, Rishi ji.
Yes. So I just wanted to understand on the operations front, a few longer term questions, right? So now that you expand beyond Punjab, how does the new branch evolution look like? Say year 1, what are the costs that you have to invest in? What is the cost to assets that a new branch possesses? And then if you have to compare it with a new branch which you add in, say, your core Punjab market, as well as a mature branch in your Punjab market, how much time does it takes for a non-core, as in say a Rajasthan branch, to reach your Punjab branch levels? If you could give me that, and then I have another question. I'll move to that.
If we come statistically, if I talk about my Punjab branches we typically categorize our branches into two buckets. That is the ultra new branch, mid-term branch, and the long-term branches. If I talk about the business per branch in my Punjab state, which is the long-term branches, that is the old branches that we can say 5-year plus branches. Punjab, we have a lot of very older branches. So if I talk about the average of put together, all of them, our business per branch in above 5-year segment is typically 106 crores. But similarly, if I go ahead with a similar thing, our out of Punjab branches, the business per branch of 5-year plus, this is around 73 crore rupees. So I'm talking about average, not a single branch. So the business per branch, if I look into the business per branch from both the sides, and despite the fact in Punjab, more than 5 means we have a 15 to 20-year-old branches also, but out of Punjab, more than 5 is technically 5 to 7 years only. So with that thing in sight, we believe the traction which we are getting in Punjab versus out of Punjab is very nearer to each other. And similarly, if we look into the OPEX or just with the sensitized market, the business will be slightly larger in the sensitized market. So but now being Punjab is not just our sensitized market, Haryana is also entering into our sensitized market. With Haryana is also being in sensitized market becoming, we internally call, we want to make Haryana our next Punjab. So that is our internal wording which we typically use. So with that statistical outlook, we believe the growth business per branch number is quite decent, and we are talking about the larger business years of these particular branches. And if I talk about the operating costing and operating efficiency, just in year 1 or year 2, Punjab branches will be more efficient. So this is a open secret, I can say. Up to the year 3, Punjab branches will be contributing more. But if I talk about our long-term aspiration of the group, so out of Punjab branches are also started growing significantly. The number I shared, 72 crore business per branch, more than 5 years out of Punjab. So we are quite confident of reaching there. So that's the reason we are maintaining a very, very fine balance. That is 50% plus branches we are opening out of Punjab and around 40 to 45% branches in Punjab, so that we can reap the benefit of the P&L and reap the benefit of the growth business expansion. So that's the way the business strategy is being aligned.
Understood. Second, I wanted to understand is your underwriting capabilities outside of Punjab. So from what I understand, you all are opting the NBFC route currently to build the book outside of Punjab. So what sort of data or what sort of insight are you able to generate, given this is an indirect way of lending versus say when you lend directly in Punjab? And is there a significant gap or it will take a longer period?
Rishiji, I think there seems to be some gap in the actual what we are doing on Punjab as well as out of Punjab. Our business acquisition is through the branch channel. What I think you are talking about is the partnership-led channel, which is we just started in the last quarter or last to last quarter, and which is not a large pie. But the number which I am talking does not include those numbers, which I called those numbers as part of our alternate channel. So as part of the branch channel, in Punjab as well out of Punjab, our business acquisition strategy is the identical. That is the branch-led business acquisition, in which we believe we need to know our customer well before we underwrite for them, and that is being sourced and serviced by our own on-roll relationship managers. And the underwriting capabilities are identical in Punjab and out of Punjab. We follow the tier 3 model. That is the branch, cluster office, regional office, and head office. And branches are the sourcing agent, which is being governed by one PD officer, which we call CCH, whose line of control is 4 to 6 branches, and then the underwriting gentleman, who is typically taking care of the 16 to 18 branches, who is a credit underwriter. And we have one commonality. In both Punjab and Haryana, or all part of area, wherever we are, we follow the MIG customer segment only. And we are following the formal income channel, and also property, which is a prime property based lending. So we have a complete similarity and we have the complete information available. We have the formal income document, we have the complete PIDs available, we have the complete scrub available, and we look forward for the primary lending relationship with that gentleman. If he has a relationship with couple of NBFCs, we aspire to BT in all. Or if we are not doing it, we consider it part of the choir. So assessment is completely done on the similar model what we are doing in Punjab and out of Punjab. Well, I think you are mentioning about a very small portion which we are doing a partnership channel in which credit risk is not ours. But that is a very different business and very small value business which we are doing differently and with a different ambition and a different outlook with a high yielding products.
Got it, sir. So, if I have to understand, say, your Punjab lending today, how much of the credit decision making would be data-based versus, say, relationship-based? And for you to replicate that outside of Punjab, the relationship lending will be a time factor. So, just trying to understand, firstly, the reliance on relationship-based lending versus data-based credit decision making in Punjab, and to replicate the same, where would you say you are in non-Punjab states?
I believe if I talk today, our majority of the lending is information-based, that is a data-based, and it is being supplemented by the PD, which is my relationship. We are following the similar model out of Punjab, that is also a data-driven, as I said, with all the data, with the income data and the property data and the need data. And supported by the PD, which is again the CCS and CCH, which we are doing Punjab, which is out of Punjab. Yes, if Punjab, my one CCH can handle my 7 branches. In out of Punjab, my one CCH is able to handle 4 branches. That's the only difference point. But the more important thing is, in both the states, our underwriting system, our underwriting process is identical. And the data flow which we are using, we are consuming all the APIs. If you mention the API, whether we are talking about Udyam API, whether we talk about all the API, we are consuming all the APIs. If we talk about the relationship-based decision, we do the PD. We do the PD or we go to the staff over my own team member, 2 different team members visit to the client and his neighboring geographies and understanding that business. Surely, for any proposal which is more than 10 lakh or 12 lakh rupees, and even from 5 lakh to 10 lakh, 1%. So that is the unsaid rule which we are following in the whole of the system. So we are following the similar underwriting capabilities, and the thing which will be gives you comforting is presently we have a 24% of the lending out of Punjab and 76 in Punjab. Our out of Punjab book has a lesser NPAs and lesser SMAs as compared to the Punjab book, and significantly lesser.
X of agri as well. Like if I compare X agri Punjab versus X agri, you're not doing agri outside Punjab, so you all are at lower SMA 1, SMA 2 in outside Punjab.
Significantly lower.
Okay, got it. So thank you. These answer my questions for the time being. Thank you for your time.
Thank you, Rishiji.
Thank you. The next question is from the line of Chinmay Nema from Person Capital. Please go ahead.
Hi, sir. Hope I'm audible.
Yes, Chinmay, you are fully audible, please.
So 2 questions from my side. If you could just give or share what does cost to income ratio look like on the fully scaled up branches, so the long-term branches that you spoke of, which are like 5+ years. If you could give what does that look like? And second question is, over a medium term, what is the strategy for CASA? As in, is there enough headroom to grow within the state of Punjab at this 3% interest rate, which can fund growth in rest of the states, or would you eventually move out and also expand deposit base in rest of the states?
Chinmay, I will take the second question first, and just a clarification. We are getting a decent deposit Punjab versus out of Punjab, that is Haryana also, and the CASA share in Haryana is identical to what we are getting in Punjab. So the deposit we are able to get both in Punjab and out of Punjab. Haryana is now almost our fully sensitized market. So we believe Haryana is the big growth driver over the periods to come. So the sensitization part in Haryana, majority of the Haryana has already been done, and we are now we have already moved towards the unbanked rural branches also in Haryana. So we have reached to that place where we have started opening the unbanked rural branches in Haryana also, in addition to the semi-urban and the rural branches. So the deposit and the CASA, if I talk about the percentage CASA which we are getting in Haryana, is identical to what we are getting in Punjab. So that is the one statement I like to make. Second statement, if I talk about the branches, instead of giving you the answer basis the OPEX, because OPEX calculating will be subject to a lot of TPMs. But if I talk about our operating profit ratios, if I talk about our PPOP, which is typically 2.1% on the entity level. If I talk about the PPOP levels at the above 5-year branches, which is above 5 years, the same number remain presently, is in the range of 2.75 to 3.25. So over more than 5-year branches, the PPOP number will be 2.75 to 3.25. Getting the OPEX of this is a very complex environment. So I can derive the PPOP from those branches. So which is much larger, which is typically 35% more than what my total PPOP. So that is what is the present number it will look like. So they are contributing in a significant way to our operating profit, given the TPMs are also being used. So we are as a steady state branches, as we are moving towards the steady state branches, the PPOP is getting maturely improving. So that is the point number 2 I like to mention, Chinmay. So even if you look into the current year, we improve our pre-operating profit, that is the operating profit, by 28% in the current quarter. Despite the fact top line has grown by 20%. Point number 2, our PPOP margin has also improved. So both the things are giving a thing. Just in some part of the current year, given the interest rate change, which was a difficult period for the industry as a whole. So those times the margin was bit squeezed. But now I believe that thing is coming out of it.
Got it, so that answers my question. Thank you.
Yeah. Thank you, Chinmay.
Thank you. The next question is from the line of Vaibhav Jain, an investor. Please go ahead.
Hello, am I audible?
Yeah, you are fully audible, Mr. Vaibhav.
So I had some question regarding the other income piece, particularly the banca piece. I just wanted to know what is our model for that business and what is our vision, because I think we can probably scale up that business. So just wanted to know what are your thoughts.
Yes, that is a scalable business. Presently, the model is typically selling to the customer who are our customer. Our objective is to be the holistic service provider and providing him the complete range of the product which my customer wants. So we are presently selling as a banca partner for our various manufacturers, which I call it the various service provider. We work with the general insurance companies, we work with the general insurance as well as the health products, for the life insurance businesses, for the 3-in-1 accounts, and for the MTSS business. So these are the 4 line of businesses which we are presently catering. That is the life, journal, health, 3-in-1, and the 5 line of business, MTSS. Going forward, we want to keep on expanding this particular size, this particular cake size, with including more and more products as we ventured into, because we believe we have reached to a place where we have a decent set of customers and we can take care of the all emerging financial needs through adding into the banca businesses. Banca here doesn't mean the banca insurance. I mean to say banca means when we can sell the third-party products to our customers, but the third-party financial products. So that is what our vision are. Our vision is that we intend that all the financial products of our customer shall be sold by us to him. That is our medium to long-term vision, that we should be the complete product provider for our customer. So that is the vision how we are taking in this particular regard. So presently banca, which is typically contributing around 9.5 crore of the operating income, is consisting of LI, GI, health, MTSS and 3-in-1. And going forward, we intend to add few of more products in each of the year as we move forward.
Okay. So this is starting from next year. You're going to add new products, or how will that work?
We intend to add one more product in FY27. So I will not be able to name the product. So I have not got the approvals. So yes, we intend to add one more product in FY27 and one more product in coming year.
Got it, sir. And as a percentage of average assets, where do you see this business, say, in the next 3 years?
There is a good upside opportunity available. If I talk about my other peer bankers, from the peer banker, I mean my mid-sized private sector universal bank. This number gross net of the AD1 business, if I talk about the trade finance business, typically in the range of 1.05 to 1.15. We are today 0.9. We believe the arbitrage between 0.9 and 1.15 is what we need to bridge. So yes, gradually we will intend to bridge that particular gap between what we are and where my peers in the similar set of customers are there. So that is our wish list to move towards that direction rather than giving any specific number for this in the current year. So this is what the opportunity is there if we look into my banking landscape.
Sure, sir, sure. Thank you for answering my question. That's all.
Yeah. Thank you, Vaibhav.
Thank you. That was the last question for the day. I now hand the conference over to management for closing comments.
I would like to thank everyone for being part of this call. We hope we have answered your questions. If you need more information, please feel free to contact our investor relations team or strategic growth advisors or investor relation advisors. Thank you. Have a good day.
On behalf of Capital Small Finance Bank Limited, that concludes this conference. Thank you for joining us, and you may now disconnect your lines.